Welcome back. It's time now for the Word on Wall Street. Top investors watching your money. Joining me now is UBS Managing Director and Senior Portfolio Manager Jason Katz. Also with us is Mark Tepper this morning. Great to see you guys. Thank you for being here. Jason, welcome to the conversation. We are talking about markets that are pulling back. Futures indicating a decline at the start of trading this morning. The Dow was down better than 450 points yesterday, and it is extending that sell-off this morning with another decline of 180 right now. The S&P 500 pulled back yesterday from the record levels that it hit the day before. And as you can see, the Dow was down 466 yesterday, the S&P down 23. FundStrat's Tom Lee, though, is talking about the January effect and zeroing in on the first 5 trading days of the new year. He says that does set the tone for what comes next. If you look back all the way to 1950, when markets are higher for the first 5 days in a new year, the major indices average about 16% gains for the year, with an 84% win rate here. This setup this year is especially rare, Tom writes, saying that we are coming off of 3 straight years of gains of 15% or more. How are you reading this early 2026 setup, Jason? Does this pullback that we've seen and are seeing this morning matter, or is the bigger trend of the January effect still holding in your mind?
As somebody, Maria, provides counsel to individual investors over 30 years, frankly, I try not to look through the rearview mirror. Yes, history oftentimes can be a guide, but like you said, there were 3 unbelievable years in the market. So when you have President Trump talking about a ban on single-family homes from institutions or a crackdown when it comes to buybacks with the defense industry, sure, that's going to be a reason why we get a little bit of a reprieve, but we remain very constructive going forward for 2026.
Yeah, I mean, this is a really important point that you bring up. The president is basically saying in an executive order, I don't want big Wall Street institutional investors to buy single-family homes. Big institutional investors are not buying the homes so that they could have their family there. No. People buy single-family homes to live in them, and he wants to ensure that the supply of those single-family homes is flowing, and that we have enough supply in the market so that rates go lower. He's also talking about dividends and buybacks in the defense sector, saying, look, we can't make our defense equipment and the military equipment fast enough. We are not even, he didn't say this, but I know this, we are not even ready today to actually push back on China should China go into Taiwan tomorrow, because we don't have the necessary military equipment and weaponry because we can't make it fast enough. So he's basically telling the defense companies, stop with the buybacks, stop with the dividend payments until we know that you're investing enough in that. And you think these are 2 negatives for the year?
I don't necessarily think they're negative, frankly. I think they're positive for the country. With respect to the defense industry, the budget's close to $1 trillion. So this may be cause for a little bit of a reprieve in those shares, but counterbalancing that is a very dangerous world, and we need our defense contractors. And with respect to the housing industry, the big institutions, well, frankly, the big private equity firms that are publicly traded, they're not forced to sell what they currently have. That'd be an act of Congress. That would face major legal challenges. Counterbalancing that, great capital market activity this year. With lower rates, you're going to see the monetization of a lot of the assets they own in their funds, boosting their profits.
Yeah, I mean, look, I know Blackstone is one of the largest owners of real estate, single-family home real estate. So you're hitting exactly where the president is talking about. These major alternative firms and private equity firms are buying homes. Meanwhile, Mark, we're on the doorstep of fourth quarter earnings. The major banks will report their earnings next week. JP Morgan Tuesday, followed by Bank of America, Wells Fargo, and Citi on Wednesday. America's largest banks expected to see higher fourth quarter profits because of a surge in investment banking revenue. Deal making has been accelerating. Analysts believe loan growth and higher net interest margins will also boost results. But the financials have been down. What are your expectations for the fourth quarter earnings, Mark?
I absolutely love financials here. I mean, when you think about those companies that are going to most benefit from utilizing AI within their company to drive more productivity and more profitability, the banks are really front and center. And obviously, yes, I mean, investment banking revenues should go up throughout the course of the year. We have a few clients ourselves that actually finished M&A deals in late 2025. I think we're going to have even more in 2026 as well. And that's indicative of a strong economy. Beyond that, when you look at these big banks, and we own J.P. Morgan, we own Citigroup, and then we own PNC as a regional bank, when you look at everything they've got going on, it's not just the investment banking. It's not just the productivity gains that'll come from AI. There's also going to be substantial revenue increases coming on the wealth management, asset management, investment management side of the equation as more and more investors are bailing on bond ETFs or positions that might pay a lower fee. And they're moving into equity positions and or even some of these alternative ETFs, which are now coming out with even higher fees. So that is going to help banks as well.
Well, I mean, look, also the SEC is making it easier to own privates. So some of those firms that you're talking about are also investing in private companies and seeing good returns. Hey, Jason, there's been some action in biotech this week, in the last couple of weeks. A surge in biotech M&A certainly taking shape. High-profile bidding wars underway, intensifying competition for next-generation assets. Signals some momentum here in 2026. Deal activity expanding beyond oncology and immunology. Growing interest in obesity, metabolic, respiratory, and neuro treatments. Eli Lilly reportedly nearing a deal to acquire biotech Ventyx Biosciences for around $1 billion. Ventyx Biosciences was surging over 35% on the news yesterday. Eli Lilly also higher by better than 4%. Then you've got AbbVie denying that it's in talks to buy Revolution Medicines, pushing back on a journal report saying that discussions were advanced. Jason, what do you make of all this activity, this flurry of activity in biotechs right now?
I'm hardly surprised. Deregulation is leading to capital market activity, IPOs, mergers, acquisitions, and in the healthcare industry in particular, with the convergence of AI meeting medicine, sequencing of the human genome, there's an unbelievable opportunity there in a sector that is woefully undervalued relative to the rest of the market. And the big pharmas have dwindling pipelines, so the way for them to fill those pipelines is to engage in M&A and buy them. So it's not a shock by any means.
Yeah, would you buy biotechs right now?
I'd buy them certainly as a basket because, as we know all too well, picking single stocks could be a very binary reaction. But healthcare, biotech in particular, especially with the aging baby boomers, there's a huge constituency of people who need these treatments as they get older. So, yes, the answer is I would buy the group. Yeah.
I mean, look, there's a lot happening. We've also got new dietary guidelines from Secretary Kennedy, which we're going to talk about later. Jason, great to see you. Thank you so much. Mark, you're with us all morning long, and we are grateful. We will take a break and come right back.